Hello and welcome back. In today's video, we are going to take a look at the Purpose Enhanced Dividend Fund. This is an ETF that trades only on the Canadian market. So if you are from the US, you can still buy this ETF as long as you have access to the Canadian Stock Exchange. But I'm really excited to discuss this ETF because when I first came across this ETF, there were two things that really surprised me. Number one, it's currently paying out a pretty high dividend, which is around 12% annually. And number two, nobody's really talking about it. So I searched the YouTube to see if there are any other channels that may have discussed or done a review of this ETF, and I couldn't find anyone. So I thought this is a really good time to talk about this ETF because I think it's not really all that popular. And at the same time, it does have some features that make it better than other similar income oriented ETFs. So, without further ado, let's get started. First, let us just take a look at the holdings within this ETF. What does this ETF hold? And if we scroll down, you will see names like Royal Bank of Canada, Enbridge, Apple, Manulife, Broadcom, ExxonMobil, Microsoft, really big companies which have well established business, very robust profit margins, pretty safe companies to invest in. So there is nothing really risky when it comes to the underlying holdings of this ETF. And in total, it invests in 60 companies. And these 60 companies are chosen based on their own proprietary strategy, which focuses on strong quality, low risk levels, high valuations, and a general positive sentiment within the market. So these are the factors they generally consider when selecting to include or remove a company from within this ETF. All right, so the portfolio looks great. Now let's take a look at how does this fund generate its income? Because on this channel we mainly discuss income oriented ETFs and this one is no exception. So this is a document which is the brochure. You will find it on their website and it sort of highlights their investment approach. So right here we can see the point number one, which is that they identified top dividend paying companies, and point number two mainly highlights what I already mentioned, the selection criteria for those companies: strong quality, low risk, good sentiment within the market, and high valuations. But the point number three, and I'm just going to expand this: options overlay. So this is, I think, something that really surprised me and in a pleasant manner, really. So they use both cashback puts and covered calls option writing strategy to generate income. Now, in the market, there are numerous ETFs that use the option writing strategy to generate income, but most of them, or almost all of them, really just focus on one single strategy. So, for example, you have the very famous QYLD, which only uses the covered call strategy. More recently, we have the QQQY, which only uses the cashback puts strategy. Even on the Canadian side, there are numerous ETFs that use the covered call strategy. When it comes to put writing strategy, the only one that I can think of is ZPW from BMO, which uses a cash-backed put writing strategy to generate income. But this is the only ETF which uses both put writing and covered call strategy to generate income, and they do it in a dynamic manner based on how the market is performing. So one thing we need to understand is that the covered call strategy and the put writing strategy are inverse of one another. So the covered call writing strategy works best when the market is flat or if it's going down. That's when the covered call strategy tends to outperform the market. Whereas the put writing strategy is employed in a similar manner, but it is the inverse. So the put writing strategy works best when the market is going up. So, because they're using this combination in a dynamic manner, I think this allows them to avoid high NAV erosion compared to other similar ETFs which stick to just one option writing strategy regardless of how the market is performing. And we can check this by looking at the historical chart of this ETF. So, this ETF has been around since 2013, that's 10 years. And we can see over here it started trading at 9.95. So we can say almost $10. And since then, it has traded around that range, reaching a high of $13 in April 2017 and a low of $7.73 in March of 2020. We all know why that happened. But if you really look about it, despite those highs and lows, it has generally traded around the $9 to $10 mark. So, with this ETF, you probably won't see any major capital gains, but at the same time, you will also not see any major NAV erosion. For comparison, if we look at QYLD, it also started trading in 2013, but since then, it has experienced a 34% drop in terms of its NAV, whereas PDIV has only experienced 8% drop, and there is a good chance that it will recover when the market recovers as well. In fact, if we look at its average return over the years, we find that since inception, it has returned an average of 8% year over year. This is actually a pretty good return. To give you a bit of context, if you compare this with the return of the TSX 60 index, which is the Canadian equivalent of the S&P 500, it is almost on par with the TSX 60. The only difference being that TSX 60 index does not pay you any substantial income, whereas this ETF pays you almost 12% annual income. Last but not the least, I want to highlight the portfolio in terms of options writing. As you can see on the screen, all the options currently are written as covered call options. There are no cash covered puts. And this makes sense because, as I mentioned earlier, covered calls option writing works best when the market is either flat or going down. And as you know, currently the market is in a bearish mode. On the other hand, cash covered puts or put writing option strategy makes sense when the market is going up. So right now, writing cash covered puts would not make sense, whereas covered call makes perfect sense. But let's say in future, if the stock market starts going up, then we will see them writing less covered call and more cash covered puts. So overall, this is a pretty good ETF. It has a diversified portfolio of large cap companies with very stable profit margins. It also generates additional income through options writing, while at the same time using a twofold dynamic approach to option writing, which allows the ETF to adjust according to the changing market conditions. And this in turn also helps them preserve the NAV. And we have almost a 10 years track record where the NAV has been preserved almost intact compared to other ETFs that have been around for the same time and whose NAV has eroded significantly. So I couldn't really find anything negative to talk about this ETF until I looked at its dividend history. Now, this is not exactly a make or break kind of deal, but this is something which I found pretty interesting. As you can see, they are paying out a dividend of 9.5 cents every month, which is great, and it gives them an annual income yield of 12%. But if we scroll down, we find that they started paying this dividend only in the year of 2023, starting from February 2023. Prior to that, for a couple of months, they were paying almost 7 cents per month. And prior to that, until November of 2022, they were paying a little over 5 cents per month. And if we look back further, we find that this dividend of 5 cents used to be their regular dividend for the vast majority of the fund's existence. And if we do the math on this, for the annual yield, it amounts to about 6.5% of income annually. So, for the vast majority of the fund's existence, they haven't been actually giving out a 12% income yield. It has been around 6.5%. And that's sort of the only concerning factor I have. The fact that this is the higher yield of 12% is something that started only in the year 2023. So it is possible that moving forward, we might actually see some NAV erosion compared to previous years, because in the previous years, they were not actually paying out this much of a high income. And since they are paying it out now, there might be some possibility of NAV erosion. So that's the only sort of concerning bit I've found. But it doesn't really bother me because when I really look at the ETF overall, its holdings, its dynamic strategy, I still find this a very compelling ETF when compared to all the other alternatives. And that is my review of the Purpose Enhanced Dividend Fund ETF. Its ticker symbol is PDIV. As I mentioned at the start of the video, if you are in the US, you will need access to the Canadian Stock Exchange in order to access this dividend. If you're from Canada, well, it's available to you by default. As always, do your own research before investing in any ETF or stock, including the one discussed in this video. And let me know how you found this video in the comment section. If you found it useful and got some value out of it, don't forget to like, share, and subscribe. See you guys in the next one.